Caterpillar Inc. ticker symbol CAT is currently trading at $297.55 a share. We go over the stock over the last year. You can see it is down around about 18% from its prior highs of $418 a share. It got hit pretty hard in the tariff news, but has had a rebound over the last few days. So what we're going to be doing today is looking at the company's latest financials and then taking it to my automated stock valuation spreadsheet to see if Caterpillar is buy or sell using the discounted free cash flow model, the comparable company model, dividend discount model, and the Ben Grimm formula for intrinsic value. So let's first put in the ticker CAT, and this will load up all the latest company financial data so we can have a deeper dive. If you're interested in this, please check out my Patreon. It's the $4 tier that gives you full access to the spreadsheets. You can do your own reviews. There's a higher tier or a lower tier if you're interested in that, but let's get back into the video. So, $297 a share, 142 billion in market cap, a PE ratio of 13.5, which is a lot lower than the market average, which is 26. Earnings per share, $22.05, and a beta of 1.2, meaning it is a lot more volatile than the market. And also, analysts do say it is a buy at the minute, $370 a share. So, according to analysts, trading at quite the discount. They do pay a nice dividend, 1.92%, meaning you'll get paid $5.70 a share. It's a very safe dividend. They pay around $2.7 billion, which is 25% of the net income and 30% of the free cash flow. If you're interested in getting paid that quarterly dividend by before the 21st of April, you'll get paid. So let's have a look at revenues. Ignore the trailing 12 months here, but 2024 full year 64.8 billion, actually down from the prior year. If we do look at the, where is it here? We have the sales and revenue for the full year 23 versus 24. It was down 67.1 to 64.8. And on the quarter as well, 17.1 to 16.2. And if we do scroll down here, we can see the different segments it's split up into. This is construction industries, resource industries, and energy and transportation, all of the segments, corporate items and eliminations. But obviously, we're just looking at the segments here at the top. We have fourth quarter 23, the largest segment, and still is their largest segment, is energy and transportation, 7.669 billion, and that is down ever so slightly, 20 million to 7.649, but in terms of percentage, negligible, but yes, down 20 million. Next largest segment is construction industries. This was 6.519 billion, down to almost 6 billion, flat, down about 8%, 500 million in the negative. And then resource industries, 3.24 to 2.96, down about 300 million again, 9%, which obviously then that brings the entire revenue down to 16.2 from 17 billion. So revenues are declining, which is not good. They are able to generate more profit though. 10.79 billion, all-time highs. Free cash flow 8.82, down from the prior year, which was its previously higher numbers of 9.8 billion. If we look at operating cash flow versus capex, you can see operating cash flow is declining and capex is up ever so slightly, which is why the free cash flow is down. Shares outstanding, they have bought back shares historically and they continue to do so, which is good. They're rewarding shareholders. So let's have a look at the discounted free cash flow model. This way, valuing stocks, looking at their future free cash flows and discounting to today. Currently, it's giving this price of about 370. This is using all of the averages, and that is actually what analysts have it as at the minute. Revenues, we're expecting 70 and 75 billion in the coming years. So based on averages, it should be growing. Obviously, it is regressing at the minute. Let's see what analysts are saying. Even in the negative cases, they still are expecting growing revenues, even on all the cases. Everything is up. So fine, let's just be a bit more bearish and we'll keep it flat. That puts us to $274 a share. Net income margins, I think we can increase this. They have increased their margins pretty steadily, so we'll put that at about 17%. It puts it at 295 fairly valued. And let's have a look at these. Yeah, okay, fine. I mean, they probably increased this to 80. You can see here, yeah, if we do 75, I think the 2022 number does bring this average down quite a bit. It doesn't seem to be a fair representation. So even fine, if we put it at 75, it's $309 a share. But the key here is this is with flat revenues. If they're able to just even grow their revenues at 2%, it will be $330 a share. So key revenue growth. Revenue growth is absolutely key, obviously, but you can see here if it has decreased in the prior year, which is why Historically, they were growing about 10%. If that was still the case, it would be $440 a share. Dividend discount model puts it at $1,200 a share. They've historically grown it at about 7%, 8%. And realistically, if they increase it at anywhere, let's just go to 6.5% would put it fairly valued. So as long as they're growing it more than that, then it is a buy on the dividend discount model. Venn Graham formula for intrinsic value. Let's have a look at what the growth of Caterpillar is, and they're expecting 10% in the next year. So this looks like it's probably going to be a buy. Yes, it is $340, which is about where analysts had it as well. So dividend discount model says it's a buy. Venn Graham says it's a buy, and the discounted free cash flow says it's a buy, based on the current estimates. Now, obviously, if the revenue keeps declining, then it would not be a buy. But the way it currently looks, it is a buy. So let's have a look at the comparable company model. This is a way of valuing against other competitors of similar industries and sizes. I do have a few here, but Caterpillar are sort of the leaders in the space. We can do with ticker DE, which is Deere and Company. This is PACCAR Inc., PCAR, and Cummins Inc., CMI. So this will load all the other companies of similar sizes and industries and loads their financial data. So we can see here, Deere & Co is actually the largest, then Caterpillar, then PACCAR. We're looking at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, and then the specific metrics in the model, EV to revenue, EV to EBITDA, PE, and forward PE. Revenue, Caterpillar has the highest revenue, smallest growth rates, EBITDA highest, most profitable, highest margin, so that all looks good. Price to sales, ideally you want this under 2.7, which is the market average. They're all under that. Price to book, you want this under 4.6. Interestingly, Caterpillar is above that. And PEG, Peter Lynch's price to earnings growth, I want this under 1. EV to revenue, it is higher than the average. Deere & Co brings this up. EV to revenue, it is higher than the average, but once again, Deere & Co brings this up. PE is looking pretty good, and forward PE, but based on average of all these, it puts it at 280. Now, if you're able to compare just to DS specifically, which we can do, you can see it puts it $360 a share. So potentially these companies have slightly lower valuations, but they are a lot smaller. In fact, Caterpillar is almost 3 times the size. But comparing to at least Deere & Co, it does look like a buy. So it does look like a buy on all the models, but yeah, I would say this is, at least on the discounted free cash flow, if they do have declining revenues, then it would not be a buy. Right guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check my Patreon. It's a $4 tier, as I said before. That gives you access to the sheet, and you can do your own reviews until your heart's content, and you don't have to watch me for videos, but I would still like that. Right guys, thanks for watching. I'll catch you next time.